Going against popular expectations, the Reserve Bank of India's 6-member Monetary Policy Committee voted to keep the repo rate and the reverse repo rate unchanged for a 10th straight meeting at 4% and 3.35% respectively. The rate-setting panel decided by a majority of 5-1 to continue with the accommodative stance as long as necessary to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID-19 on the economy. The RBI has projected real GDP growth at a modest 7.8% for FY23. Economists largely predicted a hike in the reverse repo rate to fight inflationary pressures. Reverse repo rate is the rate RBI pays banks when they park their excess liquidity with it, and therefore a hike would have meant sucking out some liquidity from the system. The gap between the two key rates, called the policy corridor, is maintained at 25 basis points during normal times. Governor Shaktikanta Das, while acknowledging that the overall system liquidity remains in surplus, also gave justification for why the RBI had left the reverse repo rate unchanged. He said the central bank had managed to achieve a rise in the effective reverse repo rate in the market to 3.87%, compared to 3.37% in end August, in a non-disruptive and seamless manner without adjusting the official rate. The effective rate is based on the weighted average rate of the fixed rate reverse repo and the variable rate reverse repos of longer maturity. To the question on why the RBI has not followed in the footsteps of other central banks in unwinding liquidity, Das said, the character of inflation is somewhat different in those economies compared to India. He said the improving inflation outlook provided comfort to the Monetary Policy Committee, which believes that retail inflation edging higher to 5.59% in December was due to unfavorable base effects. Now, economist Madan Sabnavis decodes the RBI policy review.
To begin with, we have seen that there has been a lower forecast made for inflation at 4.5%, which I think is probably the biggest surprise. But what this means when you combine it with a growth rate of GDP of 7.8% is that the government is still not sure about the durability of growth. It feels inflation is fairly benign, which in turn means that there is going to be very little case which can be made for increasing the repo rate. So in fact, while the accommodative stance was not a surprise, but the fact that it said that it's going to maintain an accommodative stance even in 22-23 is indicative of the fact that the repo rate is definitely not going to be changed, and we could be expecting the repo rate to prevail at 4%. So I think this has been a very big benefit for the markets, because the markets were expecting rates to be increased, and the immediate impact is that the bond yields have come down. The other important thing is that why couldn't the RBI actually have increased the reverse repo rate? It wouldn't have made much of a difference, because the RBI has mentioned that the weighted average reverse repo rate has actually increased from August to February, and right now it's in the region of something like 3.84%. So it's well within the corridor which the RBI was talking of, 3.75 to 4%. Now, the implication of this really is that the RBI knows that there is surplus liquidity of around 7 lakh crores. It knows that there would be situations in next financial year when these funds could be required. And when they are required, they need to be there. So rather than working on trying to suck out this surplus liquidity from the system, this particular measure of the RBI of focusing now on the 3VR rate, that's the 14-day 3VR for managing liquidity, actually is a way in which it could facilitate the government borrowing program, as well as a demand from the private sector which is likely to come up.
The expectation that RBI won't tinker with repo rate in the near future bodes well for borrowers. As floating home loan rates are directly linked to the repo rate, a continuation of the accommodative stance supports the environment of affordability. Home buyers will get to enjoy decadal low home loan rates for some more time.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.